So here's a trade idea we had yesterday, and then we actually initiated this trade. You can see that there are some trades, 3 trades that we closed in profit yesterday, and then we are still holding to these positions that we still have. And we actually want to swing trade these positions, and you can see that the market is slowly retracing against me, but I'm going to hold on to these positions for the medium to long term. So how did I take this trade, right? How did I take this trade? Basically, this trade was taken basically from a fundamental understanding, right? From a fundamental understanding. Now, let me take you through this trade, right? The news that were released when this trade was taken, it was actually, where's our interest rate? Okay. It was actually inflation news release, right? So in order for us, in a nutshell, in order for us to trade currencies, guys, we have to understand that currencies have fundamental drivers of value, and currencies are controlled by central banks, right? So currencies have fundamental drivers of value, and they are controlled by central banks, right? So what are these fundamental drivers of value, right, that central banks use to control currencies? These fundamental drivers of value are actually GDP, they are inflation, they are interest rates, and they are central banks' monetary policy, right? So we have inflation. What is inflation then? Inflation is a general increase in prices, a general increase in the prices of goods and services, right? And it's a fall in the purchasing value of money. So it's an increase in general prices, and it's also a decrease in the currency's purchasing value. So obviously, we don't want our inflation to be too high or too low, right? Because when inflation is too low, we call that deflation, right? Which is a general decrease in prices and an increase in a currency's purchasing value, right? So we don't want deflation, and we also don't want inflation to be too high, right? So basically, central banks then have a 2% target of inflation. So central banks have a 2% target of inflation. Now, central banks will then, in order to combat inflation, they will hike interest rates when inflation is above 2% target and is trending away. Sorry, they will cut interest rates when inflation is below 2% and trending away. So they will cut interest rates when inflation is below 2% and trending away from that 2% target. They will hike interest rates when inflation is above the 2% and trending away. So why do we then use interest rates to actually combat inflation? It's because interest rates have a certain effect on currencies, right? So interest rate cuts, let me get this quickly. I want to bring this closer. So interest rate cuts devalue a currency, right? And interest rates hike appreciate the currency. Now, this is what we are looking at now. So if inflation is high, it means that our currencies doesn't have purchasing value. So in order to give currencies this purchasing value, what we do is that we hike interest rates. We hike interest rates. When interest rates are high, our currency appreciates, giving the currency purchasing value over high prices of general goods and services. I don't know if that makes sense, right? So we have, in this scenario that we are sitting at, we have inflation trending towards our 2% target of inflation, right? So we've got inflation coming towards our 2% target. So if inflation goes below the 2% and begins to trend away from the 2%, what is going to happen then is that we are going to have interest rate cuts. right, in order to devalue the currency, right? So let's go to the chart then. So I hope this is clear. If this is not clear, I will upload another video then on YouTube in order for me explaining inflation and interest rates in depth, right? So let's then go to our charts. What do we know then about, or what did we know yesterday about the Canadian dollar? Is that we were going to have interest rate inflation rate news releases, right? And we were expecting inflation to come in at 3.3%, right? And it actually came in lower than expected. So it means that inflation is quickly coming to our 2% target, right? So inflation is quickly coming to this 2% target, and sooner than we know, it will be trending away from their 2% target and trending lower, right? So inflation is coming to the 2% target quickly, and inflation will soon, or sometime this year, be actually going lower than this target that we have here, which is the 2%, right? So the market is forward thinking, guys, always forward thinking. So the market, what the market does is that before something happens, the market anticipates it and actually reacts in that side before that thing happens, right? So before we get interest rate cuts, the market is already thinking about interest rate cuts, thinking when these interest rate cuts are going to take place, right? So at the beginning of this year, we knew, because there are a lot of articles and also central banks articles, that the Canadian Central Bank, which is the Bank of Canada, is actually looking to cut interest rates this year, because they see that during this year, inflation would have reached their target, their 2% target, and would actually be trending away from their 2% target. That is why then the Canadian, or the Bank of Canada, is looking to cut interest rates. And remember, we said that an interest rate cut has a devaluing effect on a currency. And at the beginning of this year also, we know that the Bank of Japan was actually looking, or is still looking, to hike interest rates, right? So hiking interest rates appreciates a currency, cutting interest rates depreciates a currency. So we can see a divergence here, right? We can see a divergence that we are expecting an interest rate cut from the Bank of Canada, and we are expecting an interest rate hike from the Bank of Japan. But then all these decisions will be based on inflation and GDP. So yesterday, what happened? We had a release of inflation, which was 2.9%, which is lower than expected, meaning that interest rate cuts might then come sooner than we expect, right? Interest rate cuts might actually come sooner than we expect. So that was the fundamental bias of selling CAD against the Japanese yen. Now, technically, what did we have then on the Cadjpy chart, right? So I will just go on our daily chart. And this is what we are having on the daily, right? This is the Cadjpy on the daily. So what we noticed here is that on the daily time frame, we had a daily high here. We had a daily high here, which was actually a supply zone, right? Because we are also supply and demand traders. So we have this supply zone here, and the supply zone, inside that supply zone, there was another zone here, because this was the first test of that zone, and then the market moved to the downside, and then we have the test of this zone right here. and then the market moved to the downside on the daily, then consolidated, and then the market came to the upside, right? So we know that the Bank of Canada is going to cut interest rates this year. We know that the Bank of Japan is actually going to hike interest rates this year. So what were we looking at? We wanted to sell the CAD against the Japanese yen, right? So this is what we had then on that day. Okay, so we note this as these highs. Remember that as a support and resistance, when a support and resistance trader is looking at this chart, at the breakout of this zone of this high here, traders will begin to buy the Cadjpy. Why? Because this zone here, resistance zone, has been broken. So at the break of a resistance zone, what do retail traders do? They want to buy that market, right? But before they bought, this is what happened. We had a confirmation candle here to the downside, right? What do they call it? It's a hammer setup, right? It's a hammer candle. They call it a hammer, right? Because it looks like Thor's, hammer, right? So when this happened, we have traders committing to their sell trades here. Let me just do this. So we've got sellers that are selling at the close of this candle here, expecting that the market is going to drop to the downside, right? Cool, no problem with that. Then the market comes and takes out their stops. Takes out their stops here, right? Because we've got stops 10 to 15 pips above this zone right here, right? So the market came, took out their stops. So this then becomes a stop hunt setup, right? How does it become a stop hunt setup, right? So we have got traders selling here. We've got their stop losses being hit. And remember, we have to be sure that their stop losses were hit, right? So we want the market to move 10 to 15 pips. There we go. A 10 pip move here. So when this happened, it was not convincing enough that the market is then going to begin to drop, right? But when we had the market from, remember that this move right here is that daily confirmation candle, that the hammer candle, that the market is going to go to the downside. So we've got traders selling here. We've got traders putting their stop losses in and around 10 to 15 pips above the close of this, or the swing of this candle, right? So when the market then moved 10 to 15 pips above this zone, we knew that there are stops that are actually being taken. And beyond that, we knew that there are traders that are actually committing to the buy side, expecting that the market is going to move to the high, to move higher. Why? Because the market has broken resistance, multiple resistance structures, right? The market has broken multiple resistance structures, so the market is going to continue to trend to the upside, right? That is what we had. So obviously, we have traders buying. And at the retest here, we also have traders buying, expecting that this zone will hold, right? Now, when the market began to close below this zone here, when the market started to close in and around this zone here, I knew that there are traders that are losing money. There are buyers here that are losing money because they were trading this breakout. They were trading the retest of the breakout, expecting the market is going to go to the downside, right? So these traders are beginning to lose money here. So as the market closed in and around this range, when the market came back to this resistance point, this is when the news were actually released. This is when news were actually released. And because of some articles that we read, we were actually expecting inflation to come in lower than expected. So when the market came in here, we took our sell trades to the downside. based on our fundamentals, we know we should be favoring the Canadian dollar because they are going to cut interest rates. And we should actually, we should be favoring the Japanese yen and selling the Canadian dollar because the Bank of Canada wants to cut interest rates and the Bank of Japan wants to actually raise interest rates. Now, this is where we took our trade in and around this zone here, as you saw from our MT4, and the trade went to the downside nicely, and we had our first take profit in and around this zone. That is where we close some of our trades, but we are expecting then the market to pull back and then continue to go to the downside. So that is the trade. But the most important thing for this trade was understanding what is happening in the fundamentals rather than just taking a trade based on the fact that, oh, this is a what are retail traders seeing here, or a head and shoulders. So this is the shoulder, this is the neckline, this is the head. Oh, this might be another neckline. This might be another neckline. The shoulder expected to come back here and then go to the downside. That's how they would look at it. But we are actually looking at who's losing money here and what are the fundamentals saying, and that is how we got this winning trade. So join us for more videos as we look into more trades and as we look into what do fundamentals look like, or what do fundamentals mean, and how can we use them in order to get profitable trades going forward.